Hi, I'm Ankita Pathak, and I'm delighted to welcome you all to the day 2 of Edelweiss Emerging Ideas 2020. The last session for the day is rather a special one for our financial theme of the day. Indian banking, regulations, and policy thereof is a unique case study. Despite the multiple efforts, India today has the highest GNPA ratio amidst the G20 nations. While there is a pandemonium in the banking and financial industry, there's also a quest for restoring stability. With great privilege, I extend my warm welcome to the thought leaders in the quest for restoring stability, Dr. Viral Acharya and Mr. Tamal Bandyopadhyay. Dr. Viral Acharya is an Indian economist who was appointed as the Deputy Governor of Reserve Bank of India. He has also served as a member of the Advisory Council of the RBI Academy and was a member of the Academics Council of National Institute of Security Management, Securities and Exchange Board of India since 2014. Currently, Dr. Acharya is the CV Star Professor of Economics in the Department of Finance at New York University Stern School of Business and an academic advisor to the Federal Reserve Banks of New York and Philadelphia. Moving on to the next gentleman on the panel today, Mr. Tamal Bandyopadhyay is one of the most respected business journalists in India. His weekly column, Banker's Trust, now in Business Standard and previously in Mint, is widely read for its deep insight into the world of finance and its unerring ability to anticipate major policy moves. Mr. Bandyopadhyay has kept a close watch on the financial sector for over 2 decades and has had a ringside view of the enormous changes in Indian finance over the period. He is a frequent speaker at seminars across India and overseas. Between 2014 and 2018, he was advisor strategy for India's newest universal bank, Bandhan Bank Limited, the first instance of a microfinance entity transforming into a bank in India. He has authored 5 books on finance. All of them have been a non-fiction bestsellers. Thanks a lot for joining us today, gentlemen. For our audience, please use the chat box to shoot us your questions that we shall take after the initial addresses. Without further ado, over to you, Dr. Acharya, for your comments on global monetary policy stance and banking nuances of India.
Thank you so much, Ankita, for inviting me to participate in the Edelweiss panel. It's about 6 a.m. here, so I feel a little bit like Vivid Bharati, starting off with Vande Mataram on the All India radio, as used to be early in the mornings when I was in India. See, the pandemic has pushed the developed economy central banks into ultra low interest rates, negative real interest rates, and they have expanded their balance sheets very, very massively in order to provide liquidity to their economies as well as actually to the global financial system, because many of the currencies such as dollars are of course the reserve assets and the savings of the world, notably of central banks, are parked in that currency. What this gush of liquidity and negative real yields has meant is that savers are earning very little on their fixed income instruments. And of course, they are looking for higher yields. As a result, costs of corporate borrowing, not just for investment grade, but even for speculative grade or junk instruments, say, for example, in the United States, have completely collapsed. In fact, they have collapsed to below pre-COVID levels. So while the risks are clearly higher, the extent of search for yield and liquidity that is driving that are so enormous that actually, in terms of financial conditions, things are looking more benign than they were pre-COVID. Similarly, a lot of the domestic savings are not being deployed for expenditures, either essential expenditures, and in many cases, they are not being deployed, even though you have received, say, a transfer from the fiscal stimulus of the government. This money, especially of retail investors, is also entering the stock markets, and the valuations there also seem rather frothy. So, given the extremely adverse nature of the pandemic shock, the global financial regulators and the governments have adopted ultra loose financial conditions, and they are being seen in the valuations. You can see it in the corporate borrowing costs, and you can see it in the equity market valuations. While the extremely positive news on the vaccines and in many countries, positive news on the health curve, not in the case of United States, where the health curve is actually still growing exponentially in its third wave. But in many other countries, the health curve is also improving. And this good news has, of course, also contributed to the positive valuations in the markets. Now, coming to India, the big question that we have to ask are three. The three big questions I want to pose. First is that are we in a macroeconomic state where we can fully pursue policies of the type that advanced economies have pursued? And there are two primary points of departure here. One is that we are not a safe haven currency the way the US dollar is. And second, that our inflation levels, whether food driven, fuel driven, core inflation driven, or cost push inflation driven, that is, that supply factor driven, whatever it be, our inflation for a period of 12 months, and I stress this, it's not a matter of a few months, it's a period of 12 months, has been between 6 to 8%. It's fairly broad based. It's not specific to a particular driver of inflation. Now, what this means is that ordinarily the capacity for fiscal and the monetary policy to accommodate would not have been that large. In fact, the fiscal hasn't moved as much in terms of its direct contributions because our fiscal deficits on a consolidated objective basis were already at 8 to 10% of GDP even pre-COVID, and are likely to rise further beyond 10% post-COVID. So what this means is that the policy space has been very, very tight. In spite of that, in my view, the monetary stimulus has been quite generous. In fact, maybe once you account for the full provision of liquidity, including the global liquidity that is chasing India after the stabilization measures, recall that when the pandemic hit, India also witnessed outflows and the equity market did suffer a significant correction. But after that, the Fed actually opened up dollar swap lines and, of course, supplied a ton of dollar liquidity, much of which is actually also flowing into India. And so, given the domestic as well as the global liquidity conditions, we have a temporary lull in the financial conditions, which is masking, in my opinion, the true macroeconomic vulnerability stemming from us not being a safe haven currency, our fiscal deficits being high, growth numbers contracting, even though in the last 2 to 3 months things have rebounded from a 25% contraction in the first quarter of the pandemic. Inflation being high, and parts of the financial sector, especially public sector banking, not being as well capitalized as one might like. So that's point number one, that our macroeconomic conditions or our scorecard doesn't look as benign as the financial conditions that we are facing right now look. Second, what is an outcome of the undercapitalized banking system, especially on the public sector banking side? As I've repeatedly said this, both in my book, Quest for Restoring Financial Stability, as well as in the report for financial sector reforms with Dr. Rajan that we put out in September, undercapitalized banks do two kinds of lending. They evergreen. So they lend to their defaulted or distressed borrowers because they do not want to recognize the non-performing loans on their assets. So this is a misallocation of credit that takes place in the economy. Or they do lazy lending, which is that they keep, swallowing up the government bonds which are being auctioned in order to roll over the large government borrowing program, especially in case of India. As a result of this, if you look at the government bond holdings of our banking system relative to deposits, they have now crossed 30%. These are the kinds of levels of government bond holdings that we used to have in 70s, 80s, and 90s when we were engaging in massive financial repression to help the government roll over its borrowings. As Dr. Y.B. Reddy describes beautifully and wittily in the foreword to my book, that the government, the public sector banks, and the central bank had become a Hindu undivided family in which no one kept anyone's proper accounts. The whole idea was to help the government tide over its borrowing programs. Now, what's a problem with this high level of government bond ownership, especially in a modernized economy with relatively freer markets, in the determination of inflation, interest rates, etc., is that this creates a nexus between the government and the financial sector. Just imagine, suppose the inflation continues ticking up. It's a risk, even though there are strong assertions being made that this is necessarily supply side driven. There are components there which are not necessarily just supply side driven potentially, because it has been persistent, it has been very sticky. Inflation, when it is so sticky, has the risk of entering inflation expectations of households, entering wage expectations of salaried employees, and through that there can be a ratcheting up of inflation, especially once it starts getting close to 8%, 9%, 10% levels. Now, when that happens, the long end of the yield curve is going to become unhinged from the current relatively benign levels. It is still elevated, but I would say relatively benign because it has been very steady in the range of 5.75 to 6.25%. Now, once that happens, there's going to be a collateral damage onto the financial sector because the bonds are losing value as the inflation expectations for the long end rise, and the bonds are actually deteriorating in value as a result of these rise in interest rates accompanying the inflation expectations rising. That collateral damage is going to further undercapitalize the banking system. And that's going to make it even harder for them to extend credit when the economy is going to start coming out of the pandemic phase, as India also starts the vaccinations. So, in my view, the banking sector is continuing to be the risk of the type of an Achilles heel as far as our recovery is concerned. It has been over the past 5 years. It hasn't been able to extend credit in a healthy manner. It's doing zombie lending or lazy lending. It's not providing credit to the middle tier of firms, MSMEs, and individuals, either at the right quantity or at the right price. And we don't seem to be getting our handle onto this problem. We keep looking for unnecessarily creative and adventurous solutions rather than actually doing what is required, which is to fix the governance of public sector banks, dilute the stakes of the government below majority, turn these banks around, and gradually pave the way for the reprivatization. There is enough private capital in the Indian banking system itself. I've been doing these calculations since 2013. Right now, the shortfall of Indian banks from the public sector banking side in a market capital sense is on the order of 50 to 60 billion dollars. The private banking system in India has as much capital in surplus, but it doesn't have access to the deposit franchise because the public sector banks are not being turned around in terms of dilution of their stakes. I note here that I'm not talking about capital with private industrial houses in India. I'm talking about capital with private banks in India. There is enough capital to move around just within the Indian banking system to turn the Indian banks around. The last point I would make is that the Indian non-performing assets were already at high levels, as Ankita mentioned. RBI's financial stability report has projected them because of the pandemic to rise to 12.5 to 14.5% levels. I don't think we have provided for much capital Along the way, if reprivatization or dilution of government stakes is not on the table, then we need to recapitalize the public sector banks. We must recognize these losses in a timely manner. Otherwise, we will once again be kicking the can down the road as we did after the fiscal stimulus of 2009 to 12 having gone bad. And then once again, that means this part of the banking sector will not be able to aid credit growth. So while it's important that the banks and non-bank financial companies be asked to retain capital, which is by not paying dividends, I think many of them need to either raise market equity or receive injection of capital from their principal shareholders so that the banking sector balance sheets are repaired along with the repair that is happening in the economy so that together they can help catalyze growth to higher levels in the quarters to come. Let me stop there, Ankita, for the initial remarks, and I'm happy to take on any further questions in the discussion with Tamal or as Q&A from audience and you. Thank you.
Thank you, Dr. Acharya, for throwing light on the macro concerns we are facing today. And as you rightly said about the NPA issues that we've been facing, the large PSU losses we've incurred since the 09 crisis, and the need to repair the banking balance sheet along with the economic repairing that we need. And we have the expert in the banking and NPA cycle, Mr. Tamal Bandyopadhyay, who's written multiple books on this recently and has highlighted the pandemonium we currently are in. So, Mr. Bandyopadhyay, over to you. Please let us know how we can repair the NPA cycle that we have created, a structural flaw in the Indian economic recovery that we have as of now. Over to you.
Yeah, thank you, Ankita. I think the structural issues have been discussed by Dr. Acharya. Let me start from where he ended. I have a slightly different take. I'm not getting into the structural issues. Had this been discussion taken place, say in February, I would have said that, look, the worst is behind us. Because Ankita, you have said that you were the worst among the G20 countries. Yes, I think I don't have the 2020 figure. 2019, our gross NPA shot up to 11.2%. That was the next worst, very close to Federation of Soviet Union. 2000, then subsequently, 9.1 it was. 11.2 was fiscal year 2018. From there, it dropped to 9.1. Even then, we are the second worst among the G20 countries. And then subsequently, it came down this March at 8.5%. I think around that time, as we are progressing to the year end, I'm talking about the last year end, many of us believe that as far as the first phase of recognition of bad assets is concerned, is over. And we are into the second phase, that is of recovery. And Dr. Rajan started the work through AQR, Asset Quality Review, in 2015. December, that was started, and it was a 6-quarter show of asset quality. After the asset quality review, it was a 6-quarter show. The banks were asked to clean up their balance sheet by March 2017. And that is why you would see the dramatic rise in NPA from December quarter of 2015. And so what was happening? You spoke about structural issues. The banks were primarily hiding their NPAs. They were evergreening. And the key reason is what Dr. Acharya said, the lack of capital. If I am the CEO of the bank and if I don't have the capital, then what do? I just don't recognize, apart from many other facts. But what is certainly puzzling is this: that's not the only contributing factor. There are others as well. Otherwise, how do we explain two very large private banks? They didn't have the problem of capital. They also accumulated a very high NPAs, corporate NPAs. I'm talking about corporate loans. So definitely that's a wrong call they took. And as far as public sector banks are concerned, it was a combination of taking a wrong call, being pushed by the government, lack of capital and everything. And then AQR came, and they have no other option but to declare. And one of the ways how they are camouflaging, if you go back, say from 2008-9, from the Lehman crisis onwards, and if you look the two sets of numbers, banks restructured assets and banks NPA. Restructured assets are the assets which includes NPA as well. You'd find the restructured assets heap was far larger than NPA from 2008-9 onwards when it started. But it started evening out, meaning the NPA is coming close to the restructured assets in 2018 and 19. So clearly, under the garb of restructured assets, banks were hiding their NPAs. And it is Dr. Raghuram Rajan in the beginning. And after that, the next RBI governor, his successor, followed it up with pretty aggressively. And with due respect to Dr. Acharya, he also showed his aggression. He was in charge of monetary policy, but his primary focus those days, because our inflation was under control and financial sector stability, etc., was not that an issue at all. So I think most of the time during his tenure as a deputy governor, Dr. Acharya spent on tackling the NPAs. So as we progress 2018, 19, and 20, I think the first phase got over. Getting over by March this year. In banks were reasonably, I would say, decently. In their approach to clearing up the mess, they have done whatever they could do. And then we were looking at getting back the money in terms of recovery. And why I am saying getting back, because the provision level of banking industry, you will see that it's pretty good now. 75-80% average would be. Some of them even more than that. And our IBC came in handy, not exactly to clean up the mess directly, but as a threat. So many of the bankers, they were constrained to use IBC because people are going to the parallel judicial system and doing a lot of other things which the crony capitalists do. But for many others, it was a stick. They were coming back to the discussion table, which they never did earlier. They are escaping, and recovery started happening. In fact, I was going through the numbers of IBC. Even though our recovery rate is far lower than the global average, it's too early to say, but the cost of recovery is on a par with all the developed markets. So as we approach the year end last year, we found that banks are pretty, I would say, upfront in because they thought there is no point in hiding anymore. Government came out with a capital infusion, even though that is not exactly adequate. They should have done more, and the recovery was coming. So we thought that everything would be far better. And then the COVID thing came, and then the latest RBI biannual health check, it says, which is supposed to come up in June, but they delayed it in July. It says from 9.1 now the in gross NPA would go up to 12.5. In the worst case scenario, even 14.7. And as far as the public sector banks are concerned, it could go up to 15% to 16.5%. So going by this number, things are not far from being over, and the responsibility lies with COVID and the pandemic. But I believe that the real scenario will be little better than what RBI had projected. Over the past, because after COVID, yes, on the one hand, there is stress on the asset side. But on the other hand, if we go back, if we really believe what the bankers are saying, and the most bankers are saying that it has not been as bad as it has been projected or as we had thought in the beginning. Two things happened. One is the moratorium, which where every borrower was given certain time not to pay back and not to pay their interest. They got some time to do, and it, of course, it got a lot of complications, and the Supreme Court stepped in and all. I'm not getting into the detail. Other part is happened is this the restructuring window, which Kamath committee recommended, and they're coming over. But if you look at the September quarter results, where most bankers are saying that the collections are, I was checking, is between 88% at the lower end and 95% at the upper end. So things are getting faster normalcy, which they are faster than what we had expected. And second, also, some of the bankers are saying, one particular large bank said that, look, the request for restructuring is far lower than what we had thought. I think Punjab National Bank CEO had gone for that. Now, do we take them at face value, or do we take them at, I mean, do we think that we believe that they are telling the truth? I don't think there's any incentive to lie, because in the current circumstances, one would actually exaggerate the negative side, unless there's a scheme and they have ganged up to project a very good talk good things to pep up the economy. Otherwise, I would like to believe that they would not exaggerate this. So if I take them at what they are saying, so I would like to believe that things would not be as bad as we had projected, as RBI and semi-annual report had projected. That's because not too many guys are knocking at the door for restructuring. Collections are going up, etc., etc. And another part is this: the bank's balance sheet is far more stronger. The lack of capital is definitely there, but if you see it in terms of providing for bad assets, which is a pretty strong. It's a pretty strong 75, 80, 90, 100% kind of provisioning they have done. So I would think that they're far more resilient balance sheet than they had. But the key issue is, particularly for the public sector banking, is the credit of rate. They could not give the loans, etc., because 10 of them, overall 11, one of them an old private banks, 10 of them were under PCA, under the RBI net, which they're constrained from giving loans because of course, the lack of capital. And now the consolidation has been happening. Now, whether it's a good and bad, that's a separate story altogether. But you have seen that the credit growth is pathetic. And overall, there is overall credit growth, and even that growth also, it's actually the private banks. Some of the private banks are taking the credit out from the public sector banks, offering far competitive rates and better service and so on. So the absolute credit growth from the industry has not been growing at all. And that leads to the key question now at this point of time, where the government probably believes, Reserve Bank of India certainly believes, and corporate India believes that banks have become risk averse. But if you ask the bankers, they're saying, look, we are prudent, we are not risk averse. Earlier, we had given loan, no question asked, and we had the problem. Now we are actually asking question. Earlier, they used bank money as equity, which Dr. Rajan had pointed out. Most of the Indian companies are using bank money as equity. They're not bringing their own money. So now we are asking them to bring their own equity, and they are not able to do that. So, and you blame us. So we are not being risk averse. We are actually prudent. It's the corporate India. It's a risk averse. So I think there's a fine line between the two. Probably both the sides are telling the truth. Banks are far more conservative. They are not obsessed with balance sheet growth. I'm talking about the public sector banks. They do not have the hard mentality because they have the price, and so they are pretty more conservative than what they are. They are giving money when the government wants them and the government guarantee. So if you see whatever credit growth has come up, it's that 3 trillion government guaranteed loans, which was initially for 4 year, then 5 year with a moratorium period, and which was initially for smaller entities, now gone up to 500 crore entities, because banks could not find so many entities to give loan. As of, I think, mid-November, out of 3 trillion, they gave just the half loan. So then the finance ministry stepped in and they retweaked that particular scheme. Now the banks are giving money to up to 500 crore turnover people and all. So that's the kind of scenario now. Credit uptake, I think the bank's balance sheet will be worse than what it was in March, but not as bad as we had thought. Things are better because till now people are talking about using different. Every English alphabet was used, the kind of shape of recovery. Is it V? Is it W? Is it L? Is it K? So on and so forth. It was like the sort of K people are telling. But now it looks like V after the vaccine, good story, etc. It could be even V-shaped recovery. If indeed that comes, we should not. I think NPA scenario would not that be bad. Credit is an issue. And the capital, the government coming from capital is an issue. So I think here we end. Just one more line before I say. Dr. Acharya spoke about liquidity. That this kind of liquidity sugar rush we have not seen very often in Indian context, even post demonetization. It's a combination of various factors, including the foreign money coming in, 6 trillion plus liquidity. At the shorter end, money is available at 3%, far lower than the reverse repo window. And RBI says it is comfortable. It's comfortable. So how long RBI will remain comfortable? That's the question. And apart from any other thing, is also might encourage a lot of entities in the non-banking finance companies to make the same mistake, getting into the asset liability mismatches and all. Getting money for 90 days CP and keep on rolling them over, and then getting hit at an appropriate time. So I think the real story we would need to see when RBI start unwinding. That will not be easy. So we need to wait for RBI unwinding, and then also we'll come to know what this little positive things I'm talking about, actually this is true, or we are postponing the inevitable. Thank you.
Thank you so much, gentlemen, for the very insightful comments we've gotten. We've laid out the context and we know what the problems are. And most questions that I am currently reading are looking for a policy prescription. So my first question is for Dr. Acharya. As you said, banks have so much government securities now, which is, as you said, is a problem going ahead because inflation expectations will rise. But do you think the fiscal stimulus India as a country has received, is it enough? If it's not enough and we were to go get more, then how would government manage its borrowings, given we have a domestic crowding out already? Our domestic savings are unlikely to be enough anyway. So as a policymaker, what would be your suggestions?
Yes. See, on the one hand, I tend to agree with Tamal that likely on the corporate NPAs, it's possible that the numbers that have been projected at the time of the breakout of the pandemic will be higher for the non-performing assets, were too high. Maybe the corporate NPAs for banks may not be as large. However, I remain worried about the personal front, actually, on individual and retail loans. See, what pandemic caused a loss in first and foremost was in services. And services that are not consumed for say 6 months, they have just disappeared. You can't go to the restaurant 3 times because you didn't go there in the last 6 months. You can't go and get another haircut that you took at home by yourself. And when I talk to people on the ground, my friends in India, what they are telling me about the service providers around them in different second tier cities, third tier cities, what I'm hearing is that many individuals, small businesses are actually facing very high problems because of lost revenues of 3 to 6 months, and the rental payments, etc., now catching up with them. Many of them are fearful about when the debt moratoria get lifted, they will have to start making full payments that have accumulated, even if the compounded interest might get forgiven. So I'm a lot less clear that we are out of the woods even on the banking NPA side. Historically, the individual portfolio in India has been very, very robust. It has actually been the mainstay of the Indian banks. If that had also gone for a toss over the last 10 years, we would have had a much major banking problem. But that has stayed on. But I'm a bit worried this time around that it is this segment that is likely to be hit the most given the nature of the pandemic and the loss of services. Now, where am I going with this? Where I'm going with this, Ankita, is that if we can create fiscal room, right now it looks that without doing any compression of expenditures, this is going to be hard. But if we can create fiscal room, in my view, there is no doubt that as the economy is coming out of the pandemic, there should be a demand push coming from the fiscal side. It can be done in a couple of ways. Maybe rather than those who are out of jobs going to the NREGA scheme, where sometimes it's questionable whether the quality of projects on the ground is really there or not, or is it just a way of transferring money to them? Why not actually deploy this labor into useful infrastructure projects? So there could be an infrastructure push from the government. And the value of creating a proper infrastructure job is that it actually creates sustainable livelihood, because infrastructure is then going to contribute to further private sector growth and so on. Second could be a direct benefit transfer, not to everyone. I'm not talking about universal basic income necessarily, but to those who are most affected, perhaps at the lower end of the income. We now have the people are banked in a significant measure. They have access to electronic accounts. We have their UIDs with which we can verify their identities. Why not use that entire digital network that we have created with a lot of investment over the last 10 years to deploy for some kind of direct benefit transfers? Now, the last point, where will this fiscal capacity come from? In my view, it can come either from a very important rationalization of subsidies that has not happened for the longest time. I think they can all be rolled out into the kind of transfer that is required right now, rather than actually continuing with the populist subsidies in the form they are in. This is something that a lot of economists have been pushing, including during their terms as chief economic advisors to the government. If that is not on table, then I think the government will have to undertake a massive, massive divestment program. And I think that is also the need of the hour. Look at India's national balance sheet when it comes to the central government, the state government, the center and the state-owned public sector enterprises. We just keep adding debt. But why should we keep adding debt to our balance sheet even when equity valuations are so frothy in the markets? Why not go out and issue equity? A form of issuing equity right now would be for the government to divest its stakes left, right, and center, undertake a divestment program as aggressively as it was undertaken in 98 to 2003. Why not appoint someone who is aligned with this agenda as a minister, as in the bureaucracy, get a team that will make it happen, rather than divestments being cosmetic the way they have been over the last 5 years. And I think if we do this, we can truly unlock the funds that are necessary to provide both a demand push and an infrastructure push that is needed in the economy. So in my view, I think the situation at the last mile on the ground for the individuals, it is not as benign as it is for the corporate balance sheets. In fact, a report by Dr. Sajid Chinoy of JP Morgan claims that if you break down the earnings of the companies, which have been very rosy in the last quarter, it's because of wage compression. It's because of compression of the employment. Now, if that is what is happening on the ground, ultimately the earnings won't be able to sustain themselves in the aggregate, because corporates are keeping too much on their balance sheet, individuals are getting too little, but it's individuals who will ultimately have to demand the products that the corporates are selling. And I think that's an important consideration when we think about whether our recovery is likely to be K-shaped, V-shaped, and how robust it will be coming out of the pandemic.
Thank you, Dr. Acharya. Very well noted your points. Earnings, as we know, is more a reflection of cost cutting rather than a top line growth that we have seen. I do note your point on the divestments, but do you think we have enough profitable CPSEs to raise aggressive resources? We've been trying certain divestment projects for a while now. So do you think there's a structural problem, or do you think it can be fixed and we have enough resources to carry that?
See, Ankita, it's a little bit of a chicken and egg problem. The moment you say that the government is willing to distance itself from the operations of a public sector enterprise by shedding stakes below majority, having a professionally appointed board, giving incentive-based compensation to the management and the both at the top level as well as the middle tier, the market will immediately price the growth potential of the company. The market to book valuation of the company will actually rise. So you don't have to sell the entire stake in one go, as long as you give a commitment of a blueprint that over the next 2 years you are likely to shed the stake from above majority to below majority up to say 25%, 10%, etc. Automatically the valuation of the company will rise. What we cannot do is to say that we are going to sell stakes just below 50%, but in some way or the other the government continues to control the operations and the strategy of the public sector enterprise, because then the culture and the nature of functioning of the enterprise will not change. So that's point number one. The second point is that sometimes it's important to sell these PSUs because they are bleeding a lot of money. I don't have to take examples of specific airlines as we speak this, but they have been costing the public exchequer several tens of crores, tens of thousands of crores over a period of time. Now, to stop loss that is in itself very, very important so that we continue to have the fiscal space that is needed in time to come. And the third point I would make is that even on the public sector banks point, actually, if you recall in 2017 October, when the public sector banking package was announced, it was actually supposed to be growth capital for healthier public sector banks. Weak public sector banks were supposed to remain in prompt corrective action. That was seen as very much welcome news by the market. I remember our largest public sector bank increased in value on just 1 or 2 days by about 1/3 of its share price. We had a close to 33% or 40% improvement in its market valuation. So I think the impact of government divestments on the seen turnaround, on the perceived turnaround of the company should not be underestimated. So sometimes bureaucracy focuses on existing market to book ratios, but what they forget is that once they give a blueprint of a divestment plan, the valuations of these companies in the markets will change, and then they can shed equity gradually, trickle by trickle by trickle, along the blueprint of a divestment from above majority to significantly below majority stake.
Thanks, Dr. Acharya. So I guess guidance and having a mid-term plan helps there. Mr. Bandyopadhyay, how do we resolve this problem of corporates' wage compression, MSMEs' lackadaisical performance, and informal sector not performing, but financial conditions look very benign? Will this cause a painful adjustment in financial markets later?
No, yeah. In fact, you have rightly pointed out this, particularly MSMEs and that particular segment. Most of them have eaten out their capital in the past 6 months. In fact, because I have started traveling, I have some on-field experience, and from there I am telling you the problem is there. It's a very interesting scenario, actually. Again, with a caveat that you will not hear too much of negativity from me, not because I have any agenda, but what I am seeing, my reading may not be correct, but that's a separate story. But what I am seeing is this: it's a very bad scenario. The large segment of this MSME and SME segment, they are being affected, and even the small time traders, etc. What you are looking at, I'm not getting into the numbers which I have, is they have eaten up their capital because of, as Dr. Acharya pointed out, the way the corporate was smart enough to cut down their real estate expenses and asking people to come home, so on and so work from home, and many other ways. But in that segment, they have a more humanitarian approach. They have not got for that kind of job cuts, and they have not given up. They still have the they're holding the property, etc., etc. In the end, in the process, they have eaten up their capital. So it's a very bad scenario. This 3 trillion odd rupees, which government said is a government guaranteed, and it's essentially a no question asked. I know the bankers are giving a automatic approval, like Ankita, you have given it. Let's say essentially you need to say no, I don't need the money. Otherwise, if you fit into that, the so-called SMA category, which is what you did not default more than 30 days, no delay in payment, etc., then you belong to that kind of category. So this 3 trillion part which the banks have not been able to disburse fully, half of it would in that segment. So it's been helping out and all. And other part is this, uh, their cash flow is a pretty, once they start, most of them, now there are within that, there are tiered approach. Now there are one tier who are in the part of the supply chain. They are dependent on the relatively larger companies to get their money back. They are the suppliers. But those who have a direct interface with consumers, their cash flow will start very fast, because the day the shop opens, the day their trade starts working, the cash flow starts, and it's a very high margin business. So on the as of now, again, I am saying that situation will unfold. We need to wait and watch how it carries. As of now, situation is not good at all. Because as I primarily said, more than debt, they need capital. But this the some part of this 3 trillion package is helping them. And then I wish that they had some other flow also, because what is happening within the MFI segment, etc., which they get support from, not every microfinance entities, particularly those are non-NBFC MFIs, they have their own issues. They have not been able to support because they have their own cash flow problem. Because do not have the rating, they don't get the bank money, so on and so forth. They are closing down their shops, hundreds and thousands of them, and or they are looking for portfolio sale, etc. Had they been in a better shape, I would have been more optimistic. But my optimism sticks from the fact that these guys' business model is as such: the day they reopen their shop, that cash flow starts, and it's a very high margin business. So it is unfolding scenario. So I don't think we need to be excessively negative about it. I think with the right kind of support, if they indeed get it, it may not be as bad. Not that every barber shop will open, or every small restaurant will open. There'll be tremendous decimation on that. But overall, as I said, it may not be that negative.
Okay. Thanks, Mr. Bandyopadhyay. So even with the emergency credit line guarantee scheme, we thought that 3 trillion would be taken away at once, but it did not happen. The disbursement is still about 2.5 trillion, and the government and RBI consequently had to extend the scheme. So do you think now credit demand has also become a problem, and it's not just a supply side issue at one end? And secondly, it's an open question to you both. We have been talking about India's credit issue for a really long time. It was an issue even in the pre-pandemic time. I think 2019, RBI had this flows of resources to the commercial sector table that used to come out. And every year we were falling on it. And I think 2019 was a year when we said we had like 88% less credit available from all the resources combined than we had in the previous year. So what is that one structural thing that India has gotten wrong? And what could be the policy prescriptions that we can help in fixing it? So over to you, Nitin.
Yeah, Dr. Acharya, why don't you start then?
Okay, sure. Yes, I just want to make one point, I think, in the context of Tamal's observations. I think I agree that by and large, MSMEs that start out and are in healthy shape will have very high margins. But I think sometimes when we think about India in the post-COVID scenario, we forget what India's pre-COVID trends were. I fail to fathom how COVID in itself could have actually just come and erased the implications of that pre-COVID trend. The MSME sector in India has been struggling for the last 5 years. The only reason why the bank NPAs on this sector are not very large is because practically every year since 2016, there has been a restructuring relief that has been provided through the banking system. for the recognition of losses. I'm actually not sure where the true losses are. My recollection from my RBI days is that if you took the private credit bureau scores, such as TransUnion CIBIL scores, actually many more MSMEs would be recognized as NPAs on bank balance sheets than they presently are. And so, if they were already struggling in the pre COVID phase, I fail to see how they can have a dramatic turnaround without equity injection, as Tamal was mentioning. Because if you keep throwing more debt at them with now a further loss of revenues, they would need such a high further markup on their products in order to make up for that lost revenues, that ultimately if you have such a high cost push, the demand is not going to pick up because people are not going to keep buying. And if it does pick up, then you have an inflation problem, which is already brewing at 7 to 6 to 8% range. So something doesn't square up for me in having a rosy picture of the MSME segment. Something is not adding up, at least in my understanding. Maybe I'm not seeing the growth impulses being as strong as they are perhaps on the ground, which could be it could be my lack of full knowledge about the situation on the ground. The second point I would make is that I think the what can be done to turn things around, as I said, there could potentially be direct transfers that could be considered. But I think systematically, I think we need to look at our banking system with really an earnest capacity to tell ourselves what are we doing. I think this is what I would like the regulator, the government, the other stakeholders in the system, including those who own the banks, those who own the large corporates, to hold a mirror to ourselves. Over the last 10 years, at least last 10 years, if not 12 or 13, we have basically used the banking system to fund the large corporates of the economy at ultra low costs, allow them to not get bankrupt, to not turn over the ownership of their assets. We have done it at a glacial pace, even if we are using the insolvency and bankruptcy code. It is a far cry from what the insolvency and bankruptcy code was supposed to do. Larger cases are still not all resolved, even though smaller cases are actually getting resolved at a very fast pace. Perhaps there is the deterrence effect that Tamal was mentioning, which is a good thing. But the cost of all this has fallen on the healthy borrowers of the economy. They are borrowing at higher costs, or they are simply quantity rationed. They just don't get credit when they want. And this is the paradox of the Indian financial system. We have credit to GDP ratio, which is about 55 to 60% of GDP. Some argue that is not that low. It's in line with some other emerging markets which have similar parameters as we are. But nevertheless, in spite of that relatively low credit to GDP in the grand scheme of things, we have close to one of the highest non-performing assets ratios in the world. And I think this is a manifestation of the poor quality of underwriting, monitoring, and collections of our banks. It is a reflection of the fact that our banks are undercapitalized and they don't care as much about where they don't have as much skin in the game of the shareholders, which is where are they lending? Are they likely to be at a loss? Of course, the one shareholder who doesn't care as much about the skin in the game and the losses is, of course, the national exchequer and the losses that they are footing for the taxpayers through the public sector banking, which on an objective opportunity cost basis now is close to 7 to 8 trillion rupees over the last 10, 12 years. And third, and importantly, is that we never recognize losses in time. We are always catching up. Even if the provisions have been accelerated to 70 to 80% now, as Tamal was mentioning, we are still looking at a net NPA ratio for Indian banks, which is way higher than the rest of the world in most cases, even if it is lower than what it was in the past. So my view is that we need a deep surgical reform of the financial sector. We need a once and for all recapitalization or divestments of government stakes. We need smooth, accelerated provisioning that's ahead of time rather than always in a catch up mode. And we need some superior ability of banks to underwrite, monitor, and collect on loans that cannot happen in the public sector banking system. The only way public sector banks will make loans if they are undercapitalized is if you set them targets from the finance ministry saying, I'm giving you guarantees, you have to go and lend out so much amount of money to MSMEs. This is sectoral allocation taking place from the center, just the way it was happening in 70s and 80s via the RBI and the government and the public sector banks together. I think this is no way to run a modern financial system. In my view, I think we are not being honest with ourselves that we are not progressing as a financial sector in a significant measure, even when since 90s, our rest of the economy has actually moved ahead in terms of liberalization and divestment reforms. Let me stop there.
Yeah, Ankita. Yeah.
Go ahead, Mr. Bandyopadhyay. I think I would add another liner for you. How much recapitalization on a cumulative basis do you think we need to clean this great Indian banking tragedy now? Do you have a number in mind?
Okay, no, no. Last question first. No, honestly, I have not done the calculation. But till now, we have spent a lot of money, and essentially, you and me, we are subsidizing the defaulters. Meaning, people could get away by not paying because they know that the public sector banks will keep on capital from us, the taxpayers. So, in some sense, in a very perverted way, we are subsidizing all the defaulters and fraudsters continuously. I don't know, but the opportunity cost, which Dr. Acharya has pointed out, which has been also, I think, year before economic survey also did, had this government put this money in bank nifty, how much they would have made, instead of this money going down the drain. So that's one part. I'll not, because Dr. Acharya has spoken enough, so I don't want to say much to add that. You spoke about this, even the 3 trillion banks have not been able to disburse. Yes, they have not, which is why they, in fact, till mid-November, they disbursed half of it. And that is after one revision, the raising up the ceiling of those kind of companies. It started with, if you remember, 100 crore companies, then 100 crore turnover. Then it was raised to 250 crore turnover. And then finally, it has been raised to 500 crore turnover. And now the government, now the feeling is this. And one of the reasons why it has been raised, I am told, between the interface or interaction between the government and bankers said, look, there is no taker for this. 3 trillion, we will not be able to fulfill. So the target, achieving the target, what Dr. Acharya was saying, it's like achieving the target. So 3 trillion we could not do if you only restrict ourselves to give this smaller money. So that's why it raised to 250 crore turnover and finally 500 crore turnover. So one way of actually making this successful is this entity, the government needs to recapitalize these entities. There's MSMEs and SMEs. They need to be recapitalized. They need capital more than the debt. They need capital. It's a free money from the government in some form, which had under certain scheme the government is trying to do. I guess I would not remember. I can't recollect the entire thing, but there is a scheme which is some form of putting in a capital. Now, talking about credit growth, I would not take much of a time. The 3 years during Dr. Reddy's time, between 2006 and 8, our credit growth was more than 3 times the growth of GDP, which is defying all kind of what the economists say, that at the highest level, the credit growth should be 3 times the GDP. So we grew about 9%, 9.5% those 3 years. Average, I would say 9.25, something like that, under the old metrics. And the credit growth was around 30% those days, 28-30%. So more than 3 times that. And since then, credit growth has come down. And the past few years, we have been just calculating how many years low. Is it 50-year low credit growth? Is it 55-year low credit growth? So on and so forth. There are multiple reasons behind that. One of the key reasons is the banks' undercapitalization. Other reasons is Reserve Bank of India putting this PCA net around certain 50% of 10 of the banks. They are not in balance sheet size 50%, in number 50%, balance sheet to be 20%, etc. Those who are not under PCA also, they have become so risk averse, their balance sheet actually shrank. So they have not. And as I said, even though you will find that public sector bank, some of the private banks have been growing at 15-20% continuously, and they are actually, it is not leading to the overall credit growth because they are taking away the credit from the public sector banking. So it's an observation, no suggestion, because I am not qualified to give any suggestion, unlike Dr. Acharya, apart from being that making the bank approach the government-owned banking system in a different way, make them business enterprises and not use them as a socio-political instrument. Only one observation I am telling you for your viewers and audience is this. Typically, we talk about public sector banks market share, which was normally those not so informed person will say 70%. Those who are informed, they will say 63, 64, 65%. Second one is correct. But if you look at that's about the stock. If you look at the incremental credit, the past few years, you will find it's more than 80% of the credit market, incremental credit market, is going to private banks. They're far lower in numbers, right? I mean, till this consolidation, of course, that has brought down the numbers and all. And not only for the credit market, even in the deposits. Now, these public sector banks are the proxy for government. They represent sovereign. But when it comes to deposit, attracting depositors' money also, they are less than 20%. So you call it privatization by stealth or backdoor privatization. I mean, if the government does not do, it's a question of a few years, you will find that public sector banking system. So all that talk about public sector bank needs to be strengthened, etc. They will erode their market base faster than most of us have been thinking. And one of the reasons you will find, even in the consolidation, you look at from the investor's point of view and price to book of those large banks. I'll not name them. Those banks who have become, after taking over one or two banks, so it's instead of one bank, is three banks, the larger balance sheet. And if I accept the logic, it's a much more risk-taking ability and duplication of businesses going away and everything, much stronger balance sheet. But market is not giving thumbs up. Market is not giving thumbs up. Look at the price to book ratios of those who have already gone through the consolidation, has become a very large amount. That clearly shows that where we are. Thank you.
Sure, Mr. Bandyopadhyay. Very good points there. I think look at them as enterprises, and as Dr. Acharya said, some deep-rooted reforms is what we need. We are running short of time, but one last question, Dr. Acharya, to you rather, that Dr. Rajan and you had warned that ultra loose monetary policies in developed markets is rather a headache for the emerging markets. So have we caught that headache in this pandemic? And secondly, we have the FX intervention adding to the domestic liquidity, and there are talks that RBI is rather having a policy trilemma where it's trying to manage price, it's trying to manage the rupee, and be a debt manager to the government. Do you think, or rather, what would be your policy prescription in a time like this?
Yeah, see, I don't want to comment directly on either the FX or the interest rate or the monetary policy that the RBI is pursuing. My approach to economics and central banking is very straightforward. You have to be structurally right in the positioning of the economy almost at all points of time. Global liquidity doesn't disappear with a warning. It doesn't tell you I'm going to go away in the next 6 months or 12 months. These events happen as sudden stops. The Fed is not going to tell you when it's going to normalize or raise interest rates. A sovereign default or risk of default emerging in emerging markets or somewhere else in developed countries is not going to announce itself and give you 6 to 12 months of preparation. It's going to happen in a relatively unexpected manner. So this idea that we can just be very comfortable with high fiscal deficits, high levels of inflation, because we are on a dramatic path of recovery out of the COVID, I think this is not the way to run the macroeconomy. At least that's not my style of central banking. As I've often said, I like to play the central banking like Rahul Dravid. I think first and foremost, you have to guard your wicket. You have to play a test match. You have to be the sheet anchor around which everyone can organize themselves. And very often that requires that you bat with a very, very sound technique. I think you can't swing for the fences while running an economy. So to me, uh, uh, and see, different parts of the economy have to perform different functions. It's clear that the industry, the government, they want very, very high growth. Okay, it's very clear their incentives are aligned with growth. So some parts of the economy have to do the task of risk management. They have to do the task of ensuring that excessive risks are not being undertaken. Excessive risks manifest themselves in the macroeconomic parameters of the economy. Now, if you disregard those signals, I think you are loading up in the same direction as the rest of the economy, and that leads to a loss of appropriate balance, something that I talk about in the book quite a lot, that it's all about striking the right balance in generating sustainable growth over decades. And that's what I hope the central bank can strive for in the years to come.
Thanks, Dr. Acharya. So as you said, sustainable and balanced growth. Mr. Bandyopadhyay, moving to your book, you've highlighted the great Indian banking tragedy and a sequence of events which have got us where we are today. So what do you think, like every country has NPS cycles, they come and go, but India's has been very, very structural. So what do you think is the sticky thing about India's banking tragedy?
No, well, and thanks for mentioning the book. Yes, it was a very honest effort to get the answer, and the provocation was our finance minister spoke on 15th October at Columbia University when she was talking about our India's dream of becoming a 5 trillion economy. Somebody asked that a question about why Indian economy has not been growing to its potential and who is responsible, etc., etc. And then her answer was, and he referred to Dr. Rajan's talk at Brown University. And she said that I respect Dr. Rajan, but do you know that when Dr. Rajan was RBI governor and Dr. Manmohan Singh was India's prime minister, that was the worst time for Indian public sector banking. And Indian public sector bank is the mainstay of banking. So somebody from that event called me real time from US and he said that, Tamal, what's happening since you write on banking? Do you agree with that? And then I looked at it, I thought, and then I reached out to all the governors for their answer. And I tried to look from 90s onwards when we abolished the development financial institutions and embraced universal banking, but our bankers have not learned project financing. Even now, they are very comfortable with working capital loans until the government role and everything else I have seen. It's a 360-degree angle. I didn't have any answer. I have only raised a few questions, but essentially what is happening for the triggers are multiple triggers, like the public sector banks, as Dr. Reddy said. Again, Dr. Acharya mentioned Reddy in some other format. I am mentioning him. He said that it's not the ownership issue, but the way the owner behaves. Referring to public sector banking. So they have been a pack of banks who are the mainstay of Indian banking, but they are always balance sheet driven, which is driven by their owner, because it's been treated as a part of finance ministry. And I refer to one Tata Steel ad, which used to be called Tisco. We also make steel. So our public sector banks can also claim that we also make banking, because they need to do so many other things, right? From registration of Aadhaar card to on the Swachh Bharat Day, cleaning up the footpath near their branches. I'm sure when the COVID vaccination comes, those branches will be used for a vehicle. So they are a socio-political vehicle, and because of lack of capital and so many other issues, there has been always continuously credit misallocation. And if you look at the entire story, and that's the tragedy over the past 2 decades, they just shifted from one set of borrowers to another. It's from steel from steel to infrastructure to roads uh, to everything else like that, and everywhere they burn the fingers. And we are going in such a way that at the end of the day there will be nobody to lend barring the government, and which is roughly now 1/3 of the money is going to the banking system, to the government, this credit misallocation. So this is a tragedy, but I wish I could call it a comedy, because if you see that we asked LIC to take over IDBI Bank, and we call it a privatization. And IDBI Bank has an existential crisis. Under certain criteria, it's a private bank. Under certain criteria, it is a public sector banks. We do throw Bank of Baroda into the ring for the experiment of consolidation. But when Bank of Baroda CEO leaves, the second person comes after 100 days. There's a gap on that. So there are multiple reasons of the tragedy, and I don't think nobody is aware of that. Or you call it comedy. All the stakeholders, including Reserve Bank of India, the government, everybody knows where are the problems. But I'm not very sure whether we are forthcoming and taking the bull by the horn. That's the biggest issue. We can keep on discussing at your forum. I think tomorrow also we can do, day after also. But unless we act before it's too late, and what are the actions point, I think Dr. Acharya has laid down the roadmap. I think that's the way to go.
Thank you, Mr. Bandyopadhyay. We also do banking is a good way rather to put it. Dr. Acharya, if you have 2 more minutes, I was reading about your explanation on Tamal's book that has come out on the tragedy, and you said it reminds you of a social satire by Sahil Ludhianvi, Fir Subha Hogi, and you have a very musical bent of mind, as we are aware. So if you could lay down the satire for our audience on a lighter note as we close this very, very tragic and intense discussion. And also, please let us know more about your book, Quest for Restoring Financial Stability, as we are all looking forward to that.
No, maybe I should just end with two songs to lighten up this conversation a little bit. So one of maybe even 3. Why not? I can just keep going. I have a Bollywood song for every situation in the Indian financial sector. So this is all I did as a deputy governor. Come up with Bollywood songs. So actually, there's another beautiful stanza in that song from Sahil Ludhianvi in Fir Subha Hogi, where, when I was reading about the pandemonium that Tamal described, Tamal actually takes an account of even several bankers actually in the banking sector. And, there is a stanza which goes as, Kisko bheje wo yahan khak chhanne, इस तमाम भीड़ का हाल जानने, आदमी है अनगिनत देवता है कम. I think that's the way to describe our banking system. I think आदमी है अनगिनत देवता है कम. The reason why I stress that is that this idea that we have to find bankers who will do the good job is not the way to go. I think we have to, clearly human beings are important, but we have to institutionally strengthen the system. And I think that's what I was trying to get it. So anyway, that's one. On my book is titled Quest for Financial Stability. If you read the prelude, it starts out describing what was I thinking when I was coming to India. And I talk about the fact that I had a 2 bullet point agenda. One was to fix India's public sector banks, and second was to move the system away from too much bank finance towards market-based finance. But on the first point of fixing the public sector banks, when I was coming to India, the song that was buzzing in my mind was लिए सपने निगाहों में चला हूं तेरी राहों में PSB आ रहा हूं मैं. Public sector banks. There's a song from Mashal when Anil Kapoor is returning after his training, is saying, Zindagi aa raha hoon main. So my arrival was supposed to be PSB aa raha hoon main. On a last note, this is not meant to make a mockery of the public sector banking system. Just take it in the right light spirit. Sometimes when I'm asked, when I look at a public sector balance sheet, which song comes to my mind? There is one very tragic song of Kishore Kumar. And because Tamal's book is titled The Great Indian Banking Tragedy, I want to end with a great Indian tragic song, which is that मेरा जीवन कुछ काम ना आया, जैसे सूखे पेड़ की छाया. This is the song that comes to my mind when I look at 40 to 50 years of public sector banking. And, it goes that सुनी रही एक डाली, उस पे तो कोई अब तक फूल ना आया. And then there is another couplet that goes very, very beautifully. जीने को जीना चाहे, so they don't want to live even if they are given a chance to live. मांगू तो मौत ना आए. Even if they want to reprivatize themselves, the owner doesn't actually allow them to be reprivatized. And then there's a last one, which is absolutely the most poignant, but I think perhaps the right one to describe an undercapitalized banking system. It's सांसों के चलने को तो जीवन कहा नहीं जाए. Just because you are breathing and you have a balance sheet doesn't mean you are alive and healthy. So, sometimes when I look at the tragedy of our public sector banks, I actually literally in the night, sometimes after writing Tamal's book review, I was listening to this song because I can't help thinking about some of these tragic songs when I think about the state of affairs. Anyway, on that light note, let me stop.
Thank you so much, Dr. Acharya. Thank you so much, Mr. Bandyopadhyay. We learned a lot in this session, and I hope there are better times ahead of us and we'd be out of this mess one day. So thank you. Thanks a lot for joining in.
Thank you. Stay safe.
Yeah, thank you so much, Ankita, for the opportunity, and good evening and good night to everyone in India. Take care. Bye.